All right, happy Friday, everybody. This is Gavin McGuire, event trader, and I am being joined by Brett Manning, chart trader, here on this Friday morning. Brett, how are you doing today?
I'm doing fantastic, Gavin. How are you?
Doing great, doing great. Interesting day for us, Friday morning here. We're going to put together the latest sentiment and flow show, and we do so with the backdrop of the S&P hitting a record high just about 25, 30 minutes ago. We are seeing it roll back a little bit after briefly breaking through that level. Brett, any quick thoughts on the markets today?
No, I mean we've been locked in a really, really remarkably persistent rally over the last week or so, and it's been downticks are just running into a flood of money that is competing just a hair under the bid constantly, and it's been really interesting to watch given some of the stuff that we're going to talk about in terms of the sentiment backdrop. But it is also that part of earnings season that I consider to be sort of in the shadow of 25% of the market cap of the S&P about to come out next week or more, but really just five companies representing close to that. Um, and it just seems like the tape becomes so preoccupied with money flows that are low turnover fund movements in anticipation of that, and it really becomes, I think, more or less pointless to try to read moment to moment pattern structures when you start to get to this phase. And so oftentimes I kind of take a little bit of a break from trading once every 3 months for about a week into those mega caps. And that's sort of where we are now. And I think it's going to be really interesting to see how the narrative develops over this
Yeah,
earnings season.
Yeah, fantastic look ahead for the tech names, especially after you get something like a Snap Chat where they
Hmm.
got completely tanked due to the weaker advertising, which is of course such a key revenue source for the Googles of the world and Facebook, and even Amazon's been picking up a little bit more on that. So, it's going to really lead to an interesting dynamic going into next week. Certainly, we've seen some differences in reporting styles from the banks to the industrials, as the industrials much more impacted by that supply chain shortage. Tech, you would think, for the most part at least, any of the internet players or software players where you just kind of plug and play and don't have to worry so much about a truck delivering an item to you. One would think that they would be the belle of the ball for this earnings season. So, if we see any sort of faltering there, that could lead to some interesting swings in the market. But so far, I would say a pretty good start to the earnings season, Brett, particularly on the bottom line, where I think a lot of people were concerned in that
Hmm.
aspect. Revenues seem to be a little bit more of the shortfall, but that's been explained away by the supply chain shortages there. People simply not able to get the products out for delivery. But definitely next week with all those FANG names coming out, it's going to set up for a pretty interesting week. So that leads us to our discussion on sentiment and flow, and really some interesting dynamics that we're going to get into, Brett. And I guess we'll start off with the AAII data, which has had a massive jump in the bullish category here. A lot of that move coming from primarily from neutral sources, but also some bears flipping over to bulls. So, what's your read on the AAII data?
So first of all, and you and I talked about this in our sort of pre-meeting. We both kind of agree that the big abstract dynamic to look out for in this edition of the show is that there's this interesting kind of contrast where we're going to talk about sort of institutional market participants that seem to be suddenly moving very sort of net macro bearish, and then there's retail market participants and also really hedge funds who are both just starting to flood back in to the market and really don't seem to have any concerns at all. And it really shows up. So there's sort of this first several slides that we're going to talk about, and then they're going to stand in contrast to the slides we talk about when we get into the fund manager survey. But this slide's certainly emblematic of that. You can see this really sharp reversal back toward a very bullish mindset among people who are part of the survey. And it's a big sudden jump, and it really looks like people just thought, well, markets tend to crash in late September and early October. We're past that window. We're rocking on into the holidays now. I better get in.
Yeah, I would be curious, and I haven't done a check back at the seasonality in this, Brett, but I know your
That
preference
would be
is
very interesting. Yeah, I actually
your
haven't looked at it either.
Your preference is always to kind of wheedle down to the bull sentiment here in the AAII. So I just flipped over to that chart. So from this chart, looking at it from 2020, it's been on a pretty steady upward trend. Is there anything that was jumping off to you here?
Well, I mean, you got the, we tested sudden concern and then just rejected that and shot right back up toward the red line. So it's a very quick and complete change in terms of people got nervous. Oh, the cycle's over. We're headed into a bear market, and then just right back to the other end of the spectrum pretty quick.
Now we're obviously getting closer to the extreme. We haven't quite hit that yet. Is that would that be a tell for you, or do you see this kind of maybe being able to, given the seasonality of Q4 tending to be a little bit stronger, for us to push well above this?
Yeah, it would be interesting to see. I think that this looks like a very reactive measure right now, so I wouldn't want to predict it because that would be sort of predicting other things. But it looks to me like people are unsure, but they're sort of, you know, momentum based. Like if things start to turn bad, everybody gets bearish. Things start to look like we're getting past issues, everybody turns bullish. But it's kind of contingent upon the flow of events, and sometimes that's not the case at all. And maybe that's because we're sort of moving into a period where the Fed is ramping down rather than ramping up, and other policymakers are too. So there's not this sense of infinite liquidity to the end of the horizon, and so that means maybe things are a little bit more dependent upon how the world actually works.
Right, and we'll get into it, but I think even tapering is going to be welcomed personally, and
I
we'll
think
take
I
a look
think that's a reasonable hypothesis. I look at it like expressing confidence in the sails and turning the motor off on a sailboat.
Yeah, exactly. So let's keep rolling through, and we'll show you some of the interesting data points that we came across. But Brett, you were taking a peek at this VIX term structure. So you want to explain this slide a little bit to the users?
Yeah, sure. I mean, this is we I don't know if we haven't talked about this one in a while, but it's a
Yeah,
really
yeah.
interesting indicator when it's doing something extreme. So first of all, so what you're looking at is basically the 1 month out VIX futures contract price divided by the 3 month out VIX futures contract price. So it's the ratio of the expected price of the VIX a month from now to the expected price of the VIX 3 months from now, and it's typically less than 1 but more than 0.8. So what that really means is it's typically the case the VIX is expected to rise a little each month. That's called a contango forward curve, and it's a moderate contango forward curve, and it's a very, very stable thing for the VIX futures market, more so than most commodities. And it's a really simple reason why that's the case. The main reason why it has this kind of consistent moderate contango is, if you think about it, it's because the further future is almost always more uncertain than the immediate future. Just as a basic philosophical point, it should be pretty obvious. You know more about what tomorrow's going to be like than you know about what life will be like 3 months from now. So, since the VIX really reflects that uncertainty, it prices into the VIX forward curve in a really stable, moderate contango. But there are periods where it goes outside of that structure. So, that moderate contango, when you look at this chart, it's when the blue indicator line on the bottom is between the green dotted line and the red dotted line. When it's in between those two things, that's the sort of standard place. Above the green line means that people are more concerned about the immediate future than they are about the longer term future. So below the red line means that people are unusually unconcerned about the immediate future versus the longer term future. And really, this takes better shape when you think about it in the context of what the VIX itself is doing. So, right now, for instance, the VIX is below its 10-day moving average, and its 10-day moving average is below its 20-day moving average, and its 20-day moving average is below its 50-day moving average, which is below its 200-day moving average. So it's a classic sort of strong downward trend. And the VIX is also, it just broke a new 52-week low, closing low. It's the lowest closing price in 18 months. So it's trending down, and it's at its lowest levels in a long time. So the VIX itself is that sort of complacent indicator. And now you see the VIX term structure It's below 0.79 for only the fourth time since the March 2020 crash. So it's the market participants are unusually unconcerned with near-term volatility, right? So if you have so relative to a jump in volatility further out or a stable sense of volatility, the near-term volatility and the idea that there's going to be a sudden sharp increase of volatility very soon, there's no real expectation of that at all right now, and unusually so. And it's the first time, only the fourth time since the March 2020 crash, first time since a couple months ago. And you can see the red boxes here show each time when it's moved to below 0.79. And each time that's been either a few days or maybe a week ahead of a top that has led to some kind of corrective move. So it's been a consistent strike. That doesn't mean that's going to happen this time. It just means since the March 2020 lows, this has been an important thing to watch out for. When people become, and maybe that's something to do with the environment constantly being really uncertain. Um, but
I, I
people
would I
become
would
complacent
say
in the midst of it.
I would say there doesn't appear to be massive sell-offs, and it just kind of may be a
Right.
correction.
Oh, sure. Absolutely. Yeah. So it's sort of a loss of momentum and a
Right.
mild, 3 to 5% kind of pullback over a couple weeks.
Yeah.
And we've seen that. We've seen that a few times in this process when you get to this kind of point in this indicator, when the VIX is trending down, it's hitting new 52-week lows, and the 1 month volatility outlook becomes, very much under the sort of plotting intermediate term outlook for volatility. Particularly, there's no problems now, is what that's saying.
Right. I would say, I mean, we got it the VIX down around 15 or so. It hasn't quite hitting that 12 to 13 level that it
No,
felt seems like we were hitting a lot of the times
but it's 52-week
last year.
lows and it's trending down.
Yeah, no, no,
So in
all
context and
very good
relatively
points.
speaking, yeah. So
Yeah, so yeah, definitely something for us to keep in mind on the backdrop. So, moving on to the inverse ETF, Brett, which is also another measure of concern here in the markets. We're seeing that start slipping back from the overly
mhm.
optimistic side here. More
No, no.
people,
Well, yeah, oh, yeah,
or
for inverse ETFs,
for the inverse
obviously,
ETF.
yeah, right. Or
Yes.
just yeah, people
So,
interested in.
so trending bullish is what we'd say
Mhm.
here. So, any thoughts on the inverse ETF?
Yeah, I mean, it's just what this chart to me shows is that there was a period where people were speculating aggressively for downside movement in the market, and relative to recent history, we are just slipping back into the area where that activity is gone now. And there was a period where people were really sort of saying, I want to I want to profit from a market downside move, or at least I want to use this instrument to hedge my portfolio. And I feel it's a real need for me to be involved in this kind of instrument. And that moved to a really high level as of maybe 3 weeks ago, and now we've moved back completely outside of anything where you would call unusual activity or an unusual focus on inverse ETFs.
Okay. So what we saw there was certainly extreme, pretty bullish sentiment, Brett, right? So that's going to bring us into the Bank of America Fund Manager Survey. And this is kind of where things start getting interested from us in terms of breaking down where you would think, okay, well, obviously it's a pretty bullish sentiment out there, but the FMS, not so much. There's definitely been a reining in terms of expectations. And to be clear, this survey was done from October 8th to the 15th. So if you're kind of curious at the days that this was being watched, and during that time frame, Brett, what we saw was the market breaking back over the 50-day moving average in the S&P, which is obviously always a key trend inflection point. So, uh, let me ask you, do you ever follow the 50 closely as a reversal in trend, similar to what Scott does?
I think there's sort of a collective psychology around it. I don't look at it as an objective measure, but I know that a lot of people do. So obviously, it when you can easily move back above it after declining down below it in a long-standing upward trend, I know that that's going to make a lot of people feel more comfortable in terms of saying that this is a market environment where they don't need to worry too much about a top-down barrier to individual equities performance.
Yeah, no, no, very good point. So let's take a look. These were some of the key bullets that I saw, Brett, and feel free to add in on anything here, and we'll obviously get in a little bit more detail as we go along. But this was the least bullish survey since October of 2020, which obviously would have been, a lot of fear around COVID reemerging into the back half of the year. We started seeing more lockdowns. So we don't have anything along those lines. I suppose you could argue, flu season being back on the rise, but it and will show the COVID concerns later on in or the lack of, we could probably say, but this seems to be a little bit more around the inflation and supply chain issues. Would you agree with that this
Absolutely,
time
yeah. There's
around?
no question about it to me.
So, but kind of funny the seasonality, I suppose. Again, getting into that word, and not that we have any strong backing, but it is funny that it just happens to occur right around October as the markets are pushing higher.
Hmm.
Cash levels jumped to a 12-month high, Brett. That's obviously kind of people were putting their money where their mouth is instead of concerns about the overall environment. So, but it also suggests when you got this amount of bearishness and that amount of cash on the sidelines, the potential for some upside.
Yeah, sure. I mean, if these guys find that they've got to be chasing into year end, like it's a
Yeah,
big factor. If you've got a bunch of really, institutional players who are being overly cautious right now, and the retail market participants and maybe some hedge funds just keep the pedal to the metal. Eventually, this cash is going to have to come back in because they can't sit out a bull market.
yeah, no, exactly. Global growth expectations negative for the first time since April of 2020. I thought that was interesting.
Hmm.
You got inflation in China concerns prominent, obviously, and we'll break down some of those numbers. China definitely jumping on, and I would assume that a lot of that has to do around Evergrande and just overall policies coming from the government. Bond allocations at all-time lows. First rate, which is kind of funny because you would think that given the pessimism out there, the bonds would be seen a little bit more of a safe haven buy, but just kind of shows how weird the dynamics are out there in this survey. Expectations for the first rate hike to be pulled forward from February 22, 2023 to November of 2022, and then a rotation to banks and energy from healthcare and staples, which would be your relative normal look at the money flow in a raising rate environment. So, anything out of that just jump off the page to you right off the bat, Brett?
No, I mean, I think that there is a souring of macro expectations in the institutional circles, and I think that a lot of that has to do with probably really kind of big sort of sine wave dynamics in terms of how long it's going to take to solve these supply chain problems, and yet still where we're headed in terms of monetary policy, and for good reasons. And I think that that just adds up to a kind of simplistic formula to start to say, you know, the bloom is off the rose. However, um, what markets actually do is another factor altogether. And again, you're looking at a group of people who have to be involved in a bull market,
With
and especially when
cash
we're
levels
coming
at a 12-month
yeah,
high.
and we're coming into the final, the home stretch, the championship rounds of the year, and that's when bonuses are on the line. And I mean, it's easy to imagine a situation where there's a sort of irrational feedback loop of chasing in
Little
this
FOMO.
situation.
Yeah, so and we'll take we'll get into the components first, and then we'll circle back and take a look at the juxtaposition between the fund manager survey and the AAII data that we just discussed. But we talked about this last time around, um, Brett, the disconnect between asset prices and fundamentals and the sentiment data that we're seeing out there, because we talked about the lower expectations for stronger economic growth, and you can see that there in the blue line. We talked about that falling into negative for the first time since March 2020. You see exactly what we're looking at. Yet here you are with the overweight equities and the
Hmm.
asset allocation just kind of now it has rolled over a little bit, probably
Hmm.
reflective in the selling pressure that we had seen throughout the course of September, but it still remains elevated. So is this simply a matter of, this is what I'm saying, but this is what I'm doing?
It's really tough to speculate on that. I mean, you've also got the rise in cash levels.
Yeah.
So, I mean, it's really something doesn't completely add up. And I really, I wish that I knew whether I wish that I knew which part of the story to fully trust, because this is a voluntary, voluntary self-report responses to a survey question. This isn't
Yeah.
like data driven by some kind of quantitative study.
Yeah, exactly. Now it did tighten a little bit from the September reading, but still, what we were seeing in the bullish surveys and everything is not what we're seeing in allocation for sure. It
Right.
also would suggest to me that we're not really seeing any rotation into bonds from equities at all. This is money
Well,
that's
no.
going to the sidelines, right?
Yeah, and bond allocations at all-time lows.
Exactly. So all-time lows, 12-month highs for cash. So that whole little drop there, that went into cash and to be used for what we will see.
Right.
um, Economic expectations, Brett, it just kind of just builds upon the expecting a stronger economy again, -6%. Now this peaked at 89% in March. It's down 19% from the prior month. So are you surprised to see how fast this kind of fell off the table? I mean, obviously we could see from past experiences, 2003 saw a pretty quick decline, 2009, obvious issues there. Probably one of the more surprising ones was that January 19th fall off. That was, of course, around some trade wars, right? Trying to think if there was anything else that was jumping out in the January 2019 fall off. But the speed at which we saw this decline, are you surprised at that, or do you think that's just kind of human nature?
Well, I would say January 2019, if it was taken early enough, was before the Fed panel discussion where Powell flipped back, and it
Yeah,
was after the Christmas crash, and the Fed tightening despite the market seeming to say it's wrong to tighten then. So I think
yeah,
that was
policy
that was a
misstep.
policy issue. Yeah. So, but now I think it just seems to be, I think, growing recognition that solving the supply chain problems we have is way more complex than we thought. It's just
Yeah,
it's like hitting a big giant traffic jam on an interstate where everybody's just basically parked. But there's no reason for it. There's no accident. There's just somebody makes a
rubbernecking.
misstep, hits their brakes, somebody sees a brake light, they hit their brakes, and it just ripples backwards and grows, in a feedback loop. And it's just, if everybody were more well coordinated and everybody were just driving 5 feet away from each other at 75 miles an hour, there'd be no traffic jam. But getting that coordination down is almost impossible. And these complex systems have these ripple effects. And I think we're just seeing, you like one that I heard is there's so if there's a delay past a certain time of day in terms of some truck depots, then they can no longer make 2 truck deliveries in one day, and then they lose half their capacity because of a 30-minute extra delay. And it's difficult to predict that. But losing half the capacity, when you extrapolate that out over multi months, it just completely cuts off another industry. And then another factory can't possibly do as many units per week runs in something else, and then you get another sort of qualitative step back, and these things are rippling across everything. And it's just we it was hard to understand how complicated restarting things would be, and now I think people are starting to realize it's just, we're going to be in this traffic jam for a lot longer than we thought. And I think
Right.
that's
And
one of the biggest factors here.
yeah, no, it certainly is another factor that I think is underappreciated. When the Trump administration really started stepping up the trade war with China, that really drove sourcing to a lot of different areas. And what that does too at the same time is you've got a lot of different vaccine mandates going cross borders,
Hmm.
where one of the big issues every month on the 12th, I post the cash transportation index,
Hmm.
and,
Yeah.
and it's a great read on what's going on there. And one of the key things that they were talking about that was really screwing things up was for you to get into from the United States to Canada, you need certain things taken care of on your
Hmm.
vaccination
Right.
status, which could be different if you're going then from Canada to Greenland or whatever, wherever the
Right.
other area might be. So you're seeing these trucks, these ships, and everything really delayed because there's no global way of addressing vaccination status or allowing
Right.
different people into countries. So that's a big area.
And
You're
then you got
also
labor shortage.
labor shortage, and again the vaccination card issue is really driving a lot of the shortage now too, where truck drivers, that if you got a company like a UNP or something that is a government contractor and now looking for vaccine mandates, you're seeing it right at home with the Chicago Police Department and stuff. People are
Hmm.
just walking off the job rather than get vaccinated. You're seeing it in college sports. You're seeing it all over the world, but where it's not really reported that it's been huge is this driving shortage. So,
Hmm.
it really behooves the governments to try to get some sort of global vaccine methodology here. But the problem is, then you got to get the people to go along with it, and
There's
that's
another
proven
coordination
difficult.
problem, right? So there's multiple different coordination problems. And then yeah, I think also there's just been underinvestment. So in
Yeah,
the deepest, darkest periods of the pandemic, it's impossible to mobilize $1 billion of investment towards something that could only work in an environment that's not a pandemic, because you don't know how long this is going to last, and everything gets put on pause. And it's like the oil investment thing. Like it crashed, it started to move back up, but hey, when's the next lockdown coming? That's where we were in October. When's the next lockdown coming? Nobody's going to massively invest in expanding production capacity or expanding production in the middle of that. So everything goes on pause. But that's a rolling curve. That's always something about a year in the future. If you don't invest in October of 2020, you don't have extra capacity in October of 2021. And we're suffering from there being this move off of a curve, a
yeah,
standing curve over the course of years and years and years, where we diverged from it completely for a year in so many different things, in so many different raw goods productions, and in secondary goods. So many things that are important. The production capacity itself suffered malinvestment. So you've got these coordination problems, and you've got these malinvestment and capacity problems, and they're adding together to be something that's just going to be much longer lasting.
yeah, and obvious in this survey here.
Yeah, and I think
Uh,
that the people with the research and understanding of that are having an awfully difficult time starting to feel like, they're comfortable with this context. But again, you know, if this valuation is irrelevant in a late
yeah,
stage bull market.
exactly, and that brings us to our tail risk part of the segment, where we just saw a big spike in inflation up to 48%. It was number one last time, but it was only at about 26% in September. China has jumped in from out of nowhere, which is, I don't know, kind of funny because I mean it's not like the China issues that we're looking at is anything really all that new, but
No,
that
right?
makes up 71% of the tail risk replies that we're seeing here.
Yeah,
Asset asset bubbles has declined, still the third largest. I don't
you
know.
wait for
Like
next
we're
month
yeah, I
on that
suppose
one,
so.
right? I mean, if you
Uh,
got all of the people in this survey, this is their answer. And if they're worried about retail investors just launching the market out of their reach as they sit there in cash, they're going to be. I mean, I would think asset bubbles will be the way that that pops up. But
yeah, no, that's very fair. Fed taper has popped on, which is funny because you kind of look at
yeah,
inflation, you look at Fed taper, there's a little bit of a confusion there, I would say. The COVID-19 Delta variant, that's fallen off cliff here. It's down to about three
yep,
four percent.
yep,
U.S. fiscal policy, again, given where inflation is it concerned that it comes on or comes off? Would be the question that I have, and then other, not sure what would be thrown in the other, Brett. But when you're looking at this, it's funny because I see Fed tapering and U.S. fiscal policies is possibly offsetting inflation, but they're both obviously key tail risks that are in the market mind. So, what's your thoughts when you look at this chart?
Yeah, I mean, just the top factor I think is really the story. So people are and I think that you go back to our conversation on supply chain issues. There's a burgeoning realization now that this is going to take a lot longer. If this takes a lot longer, then there's a massively increased risk that that it metastasizes into consumer expectations on price. So I think that that's what's changing right now. I think over the last 6 weeks or so, there's been an increasing realization by people in the institutional management community that the supply chain situation is much more complicated to try and work out than we thought, and it's going to last a lot longer than we thought. And the second that you start to expand the duration of that dynamic, you start to introduce the growing potential that the average, agent in this economy will become inured to the concept that prices steadily rise for the things that they want, and then their behavior starts to change, and that's when it becomes a significant problem. And I think that people are just starting to realize that risk is heightened massively if this whatever, even if it's, this push side inflation, it can still metastasize into the problematic kind.
Yeah, and I would note the China one's kind of interesting because we've seen Chinese assets on the rise since the timing of this study. So, while it
Yeah,
might
and
be,
the other thing is you don't know whether what they're talking about is this sort of, this kind of one thing we talked about last week is there seems to be this shift in terms of the Chinese Communist Party's long-term agenda, and it was toward externally visible economic growth and becoming a economic growth superpower, and now it seems to be shifting toward internal controls on cultural norms. And
right.
that could be, so there's one theory. Are you talking about China just sort of not prioritizing its economic growth, or are you talking about something like Taiwan, and the possibility that China just
Geopolitical
starts to
fight
basically just
now.
march into Taiwan and put a flag in the ground?
Yeah,
And
which
what's going to happen then? What are we going to do? We're going to do nothing. And
yeah,
it's
yeah.
just,
Even with that semiconductor production coming from that region, like you said, I mean that's why I think we're seeing so many
yeah.
people rush to diversify
Well, but
out
there's going to be a
from there.
lot of, there's going to be a change in the economic landscape of the world at that moment. And there's like a 4% chance that anybody else in the world is going to try to do anything about it. But that 4% chance has been something that stopped China from trying to do this for a long time, because is it worth that risk? And maybe they're at that point.
Yeah, and it is funny because I was watching an argument on what the U.S. would do, and I agree with you. I don't see the U.S. going to war over Taiwan personally,
There's no way.
especially if we're able to procure chip production elsewhere.
It's already like they've spent 15 years building up, a kind of protective,
Yeah, yeah,
like
they could
they've already
overtake
done
Taiwan in
this.
a night.
They've already done this in every respect except sticking the flag in,
Yeah,
and it's years and years and years in the making. And at that point, the chess pieces are all in place. We're not just going to fly into the middle of that.
no,
So
exactly.
yeah, we'd have to have an international coalition consisting of every other country on the
And,
planet.
and there'd be sanctions on China and all that, but
Yeah,
it's not going to change anything.
but it will inflame our relationship with them. And so
Yeah,
that's kind of so the
but I mean,
upshot is
we've been
that this is a
pivoting from
further
that
problem.
for yeah, we've been pivoting for that for a
Right.
while
But
now,
it
right? So
removes any hope of repairing it, maybe. And maybe that's what's reflected in the survey. I don't know whether it's that or if it's the other thing about China just no longer
with the ever
prioritizing its economic growth.
right, or if it's even just the Evergrande credit issues. I
Hey,
mean,
maybe, right?
so, but yeah, a little bit more clarity there. We need subcategories on that one.
Yeah, right.
All right. Any of the other areas that you wanted to discuss? Real quick with the tapering, Brett. Good chance that they'll move forward in the November meeting with that, which is only less than 2 weeks away now. At this point, we just got the beige book out. So, personally, I think that you could see a quick selling, but I think the market's going to appreciate the tapering and understand that it's a necessary step. It's not going to change anything on the rates just yet. Maybe one step closer to that, but I see that as a buy the dip possible opportunity.
Well, yeah, and I also would say that I think we just got the announcement, didn't we? I mean, Quarles 2 days ago, was basically it. He just said, we have met our requirements, and so
Yeah,
tapering will begin in November.
yeah.
So I
I
think
mean, we've
we
been
got it,
seeing
and
it.
the Dow shot down 200 points in 20 minutes, and that was it.
Yeah, especially if markets are near all-time highs. I think
And
that'll
we've
give
discounted it.
The
I guess
Fed
is my point.
clearance to be able to announce it in that sort of environment. I think they'd rather do that than be the Grinch and announce it a week before Christmas. Personally,
Yeah, and they would also not want to do it when markets are under pressure. But the rally gives
right.
them full clearance to do that.
Gives them full clearance. Okay, moving on from tail risk, inflation expectations. Funny to see this kind of falling off here, Brett. It's on a year-over-year basis, so this would kind of fall in line with the Fed's transitory, I would say, when you see this big decline in it. Obviously, I suppose if you're looking at year-over-year comps, that's going to get a little bit harder for inflation to continue its torrid run. So maybe it's in that aspect. But I was a little surprised to see this chart, given that inflation is the primary concern for the markets.
Yeah, it's difficult to square the two. I suppose this it depends on the time frame. So let's say the time frame is over the next, where's inflation going to be a year from now versus now? And I guess the you could square those two up by saying what people are concerned about in the previous slide, with inflation being a huge tail risk, is the Fed having to tighten fast, right?
Yes,
By these expectations.
which is easily the biggest concern around inflation, right? And
Right, and
and
then
we,
that
we've
leads to
seen
a
that a little.
deflationary, yeah.
We've seen that a little bit with the flattening of the yield curve, which is a bit of a
Right,
concern because when you see the flattening of the yield curve, that's usually around rate policy and expectations for the short-term rates to
right.
see an increase because of rate hikes, as opposed to long-term growth, which is what you'd see at the long end of the belly. So, uh,
Absolutely. Right. So in other words, those two charts make sense together if what they're really saying in the previous slide is inflation causing monetary policy making panic causing a recession.
right. So I guess that's how we'll kind of mix these two charts together because otherwise they definitely are a little confusing. And the transitory debate, Brett, obviously we're seeing a pickup from permanent. Won over 10% of the votes from the last time around, now up to 38%, expecting this to be a little bit more permanent. So, you got any thoughts on that chart?
Well, I mean, I think it's the same thing we talked about, right? I
Yeah,
mean, if you start to metastasize the supply chain problems into consumer expectations of price.
yeah. All right. So we've already talked about the slowdown in growth expectations. We talked about inflation being a primary concern. That naturally leads us to talks about peak boom and stagflation
Actually,
concerns
you know
that
what? Let me insert one more thing. So, in
sure
squaring those charts, there's another dynamic that really we should have pointed out as well, which is maybe that what that chart is showing is second derivative dynamic. So is inflation going to accelerate? But it's already high. So it may be
you're
net
talking
percent
about the
saying is it going to be
inflation
much
expectation.
higher? Yeah. The
Right,
one that
yeah,
says yeah.
which is what I said. Like if this is a year over year comparison,
Yeah.
obviously it's
If
going to
it's
be
already
very close.
here and it stays here, that's a problem. But still those people would say it's not increasing further, but it's still a problem.
Yeah, and I think that's key because right when we started seeing the bottoming in the S&P, that's when we started getting a lot of that inflation data, and we saw the market digest it. And it wasn't because the inflation data was low; it was because it was showing a deceleration from
Yeah.
the
Second
prior
derivative
couple
dynamics.
months.
Yeah.
So that is an important aspect. How quickly do we get to that inflation? Do we see it just pop here and kind of flatline for a little bit, or does it continue to rise? That's definitely going to be a key aspect for the
Right.
markets, right? So, which again brings us to this peak boom stagflation concern. And um, so I thought the PMI numbers today, Brett, were a pretty good argument against stagflation. So, stagflation, of course, generally being extremely low to no growth and high inflation, which is obviously a bad scenario for the markets, forces the Fed to move, even though growth is already kind of being stagnant. So the thing is, though, and just if you take a look at any of the economic data, retail sales from last week, GDP, whatever it is you might be looking at, or these PMI numbers where they all ran well over 50. The US number was nearly at 60% for manufacturing and 58% for services. There doesn't appear to be any growth concerns out there. You see it. I know a lot of companies are missing the revenues, but that's because of supply constraints. But everybody is doubling down that the demand is there. You're not seeing any sort of dry up or
Yeah.
whiplash effect. So I think the argument for stagflation is a little weak, Brett. What's your thoughts on that?
I think it's very I think there's often times that I've noticed in the course of growth trends where people find reasons to become concerned or afraid, and they lose sight of the sort of plodding grassroots dynamic that's always there in the background, which is growth. You know what I
Right.
mean? So
Yeah.
like you can see like the companies are really doing it, especially when, as we start to get less and less problems with the labor shortage, which is, gradually going to happen, that people are going to come back to work. There's certain things that are limiting them, like the kids need to stay home from school, or they've got these unemployment benefits or whatever, or and then there's maybe even a lag just after that in terms of actually, coming back to work. But it's going to happen on some level. So when there's a more of available supply of labor, then you get to be able to do more orders, and et cetera, et cetera, et cetera. So there's releasing upside potential there, and there's constant demand growth. So there, but it's just background noise, and then there's these larger dynamics that maybe analysts and fund managers get overly focused on at times, and they lose sight of this kind of background constant growth situation that we seem to be experiencing.
Yeah, and I mean, you just see this is popping up to its highest levels since 2012. But again, I just don't see it playing out in the data.
Right.
And that's a key concern. Obviously, we'll be keeping a close eye on that. And I mean, certainly there's the argument that growth has decelerated, but I feel like we're also at levels and at comps where it was only natural to see a little bit of a deceleration on that front.
Right. Sure.
So, and again, just kind of keeping an eye, but we're talking about this, looking at the Google Trends, which is simply searches for stagflation over the last couple of years. And you can see the last time we saw a peak this high was 2008. And now we're seeing that rise again. So it's certainly pouring into the zeitgeist of America there. Do you think that it could be a self-fulfilling prophecy?
It's not inconceivable. I don't know if that's been the primary uh, 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 causal situation, but I get what you're saying. Yeah, I mean,
Yeah.
if everybody becomes worried about, that's sort of like moving into consumer expectations on some level. But you know what's interesting about this chart is the cyclicality of it on an annual basis.
Yeah, it is funny. I wasn't even
I
really
don't know
looking at that.
what when is that? When is that? There's a spike. It looks like every year at a
Yeah,
certain time of
I'd have
year.
to go back on Google Trends and probably extend it out, but yeah, it
Why
does
does
seem
everybody
to be
start
a
searching for
rotation.
stagflation once a year at a certain point of year?
Yeah, right? That is pretty funny.
Uh,
Does the
Is there
time
like a
frame
stagflation conference once a year or something?
I
Is
I don't know.
maybe there's like a gold bug conference? There's some. That's really interesting.
Yeah,
That is.
I mean, there's 11 incidences over the last 12 years, this being the 12th one. So
It
yeah, it
looks
seems
very
like
annual. Yeah. Right.
maybe there's an annual stagflation conference that we're unaware of, Brett, or
Yeah.
something, but that is pretty
Everybody
funny.
starts there. Yeah. Right. Sure.
All right, and
And right now, I'd just like to point out, is not at that seasonal point.
yeah, yeah, a little bit pull forward there. It seems
It
like
looks
it's
like it's
usually more during
summertime.
the summertime, yeah, right?
Yeah.
Like the end of the summer.
Yeah.
Probably because everybody's just spent a bunch of money on their holiday vacations and haven't worked. So
Maybe. I
that
don't know what that
inflation is
is.
here. I don't know, but that is a
Is it
funny
Jackson
dynamic.
Hole or I mean,
I can't imagine it's Jackson Hole. I don't know.
no.
I don't know. I'll have to take a closer
Yeah, I
look
want to know.
because the chart. I mean, this is obviously a 20-year chart, so it doesn't give us a great read on that. But all right, let's take a look then here, Brett. Rate hike expectations. We were just talking about quarrels there, and certainly the last dot plot suggests that expectations have been pulled forward. And it's reflected here. I don't see anything that's jumping off in terms of out of the ordinary from what we're looking at.
No, right, sure.
All right. The yield curve, we just talked about flattening here, and the expectations have increased for that. So again, that just kind of points to people expecting the Fed to move because of inflation. The net percentage of expecting a steeper yield curve dropped to the lowest level since, I guess we'd have to go back to 2019. So nowhere near the 2018 or the 2011 lows or anything like that. So would you like to see this arrested at all, or do you think that this is probably going to be a continuing pattern until we get that first rate hike?
The flattening curve?
Yeah,
Yeah, I mean, I think it's the second derivative dynamic as well. But souring of growth expectations. So I think that this is, I mean, I don't know whether we'll revive those growth expectations. So we've talked about the possibility that people are losing sight of something like what was reflected in the PMIs that you talked about. But and the other thing would be, we could see trading dynamics take hold in terms of how people are positioned. Um, sort of crash at the long end that could suddenly steepen things, which has more to do with inflation expectations. Um, I don't know, but it's certainly notable that we are seeing. We saw the big spike, and this is standard cycle, right? I mean, the early stage of an economic recovery rebound, you see this massive steepening, and then pretty quickly it starts to tail off. And it'll be interesting to see. I just think that the step of officially announcing tapering, I really think is just completely discounted into the situation at this
I
point.
agree. I
So
agree.
it will be other things that influence this.
All right. Then, real quick, Google trends inflation is probably poor placement by me on this slide. Not really a lot to add. We kind of talked about that with stagflation.
By the
Don't
way, it's
really
every April and May.
every April and May, huh?
There's a
Tax
spike in
time.
searches for the word. Oh, I don't know.
I don't know why taxes would really play into that.
But I mean,
So
it's a huge shift every April and May,
that's
and
funny,
the run in through April and into May. There's a gigantic jump in searches for the word stagflation.
huh? Sell
Really
in
like
May
to
and
know
go
why.
away. I
I,
don't
I
know.
can't imagine. It's just I would
Yeah,
have to do searches with other similar terms to see what else is. I mean, like I could do one for gold or something. But
right.
either way, conversation for another time. It's interesting.
Yeah. So as you can see, inflation's popped up to its highest levels because really inflation's something we haven't had to deal with in 20, 30 years, right? So,
And let's
um,
crowdsource it. Hey, you guys out there, if you are able to help us understand why every year in April and May there's a surge in Google searches for the word stagflation, I'd love to hear it.
yeah. All right. So, naturally, inflation assets seeing a boost. No surprise here, right, Brett? Commodities, banks, among the two highest weighted in terms of positioning versus historical scores. Bonds, obviously, getting crushed. Emerging markets down. Utilities, staples, all things that you would expect to see with with the tapering expected here. So, no surprise on this front, Brett.
No, no, right. It was
Okay.
so it the search term inflation, which you have right, is also, by the way, same seasonal cycle.
Yeah, yeah, it's funny. So, okay. So there's the inflation assets, energy and inflation. I was a little surprised at this, but not as much correlation as you would expect. Only 47% since February of 2008. And I'll combine this also, Brett, with this, where 49% of investors don't think oil will exceed 100 in the next year, which makes me think that it will. You got any thoughts on energy and inflation here, Brett?
I think this is so clearly a trend that's being driven by supply side factors mixed with a relatively steady demand situation. And I think it's underappreciated the extent to which the United States, I mean, the shale industry has imploded, right?
Right.
It has imploded, and they just were not positioned for what happened last year, and it's just imploded since. And there's a lot less investment in new production capacity. Yeah, Putin came out yesterday and started to talk about this, this 15 to 30-year cycle, and how we have seen something like a 40% shortfall in terms of over the last several years in terms of investment in capacity, whereas from like 2010 to 2014 it was at a certain level. From like 2017 to present, it was way under it, and then hugely under it last year. And these are the factors that are driving what's happening in oil, much more so than anything else. And the fact that the United States, you got to remember where OPEC Plus came from. It came from the fact that OPEC, which was by itself until early 2016, for 50 some odd years, had a situation where they controlled enough of the what I call the global production pie to be able to set policy, because what they did really dominated price. But when enough production started coming from outside OPEC controlled producers, then suddenly they don't control. They can make a change in policy. It really doesn't matter because there's so much oil coming from other sources that are not reacting the same way, that they just lose market share. So they saw this problem in 2014 and 2015. They eventually solved it by bringing in other countries, most notably Russia, which is like the fourth biggest producer in the world. That gave them control of a large enough amount of the production pie in the world to be able to start to control policy again. But now that structure is still in place. And the big problem that they faced was the United States' growing role in global production. Now that's deteriorated massively. So OPEC right now probably has unprecedented control in its entire history. And these guys, the last time they had really powerful control, they ran the price up above 100 and they kept it there. They kept the 200-day moving average of oil above 95 or so for like 3 straight years. And that's what they do when they have control. They try to bring it up naturally, they try to bring it up slowly, but that's where they want it to go. And they have complete control right now. So I think that that's probably an underappreciated part of what's happening in oil.
All right. So moving on, we talked about bonds being the most hated asset at an all-time low here for the pessimistic outlook in the fund managers survey. This dates back to 98, of course. No surprise there in the positioning. Do you have any thoughts on playing a TLT or anything like that, Brett?
Uh, uh, um, yeah, I mean, I think like we talked about with the yield curve, I think that the tapering is totally priced in, and what we're talking about right here is the underappreciated aspect to this is the divergence between the United States and other areas around the world. And if there's a limiting factor that's keeping rates constrained in the United States, it's simply cross-border flows. Super fungible market. If the United States interest rates get that far away from, say, Germany or Japan, it's real easy for people to borrow money in one and put it in the other, and it kind of stabilizes that picture. So you really need global interest rates to start to rise for this to break out.
Okay. Fiscal bill expectations, I think that's running in line with what the market's kind of looking at about 1.7 trillion,
Yeah.
certainly from commentary that we've seen. So, no surprise there. What do you think the reaction is going to be if we do get a $1.7 trillion bill?
Nothing. It's over
Not
10 years.
see, I think we see a spike, and then I think we see things roll over real quick.
It's not 1.7 trillion coming in the next few months.
No, I get that, but I just kind of look at it as it'll pop, and then inflation fears will start to rise. You'll see rates start rising. You'll kind of see a rollover in
Hmm.
growth at, but nothing big. I'm talking gyrations within
Yeah,
a 3 to 4 day period. I'm not saying a change in trend or anything like
but I
that.
think it's a non-factor, but it maybe has, like you're saying, a superficial impact.
It'll cause volatility, I think, and provide a boost to renewable plays, I would say.
It should, but then again, it's over 10 years.
Okay. Hedge fund positioning, Brett, this was a slide that was kind of jumping out. Net equity
Yeah.
exposure falls drastically in October. Do you think that they're actually doing this, or do you think that this is how they're responding?
So I think that there is there's multiple ways to measure this factor, and they're disagreeing right now. And I don't know which one to trust, but the one that I typically use is a model that shows hedge fund exposure based on the difference or the relationship between what their benchmarks are doing and what the major indices are doing, because it shows sort of moment to moment and across a 3-month time horizon, uh, uh, how much they're participating in what, say, the S&P is doing. Like, if, for instance, if their benchmarks shift in a way that's different from the S&P, you know that they're really not that much exposed directly on the long side. So is there a correlation between the basic HFRX and SPX on a day-to-day basis, and what the degree of that correlation is? I think that that's a good way to look at this. I don't know where this data is, like, self-report for the hedge fund part of the survey, I guess. But the other measure that I just talked about is still you know, really elevated. And it's still, hedge funds are more exposed than they have been on average over the last year easily. And that chart that we're looking at here completely disagrees with that idea. So I don't know which one of those ideas is correct.
All right. And then that's going to do it for the fund managers survey for us, Brett. Um, let's do a quick take then. So we obviously saw a little bit of a difference between the AAII and the fund managers survey. AAII being a lot more bullish. Really, the timing of the surveys did overlap a little bit. So it's kind of confusing to see that. And I guess the real question is, are fund managers just kind of trying to talk down the markets to get into a better buying? Or is it simply just a retail driven market where they've really taken the reins and are pushing things forward? What do you think is the general reason for for the divergence in these two surveys?
I don't know, but I could be sold on the idea that, like the late 1990s, you see an environment where people who know more and focus more and have more experience aren't able to stay with a bull market that starts to diverge from, normal expectations of relationship with economic growth and valuation boundaries and et cetera, because it becomes a cultural experience, and it's just it, look at GameStop in February. I mean, like there's no way, if you're basing what you're doing on rigorous quantitative analysis of real, economic data and long-term relationships between concepts like valuation and price movement, et cetera, that you're going to be able to use those types of ideas to keep involved in something that just becomes swept up in a sociocultural experience by a lot of people who don't have anywhere near as much information as you do, but are willing to participate and control trillions of dollars of capital. And I think that it's easy to see, um, to me right now, that we're starting to see a little bit of that. And the question is, can it be sustained in terms of the retail participation? And my guess is it probably can. And will we start to see an in a capitulatory increase in participation by people who are concerned about this market for reasons other than what's driving it? And I'm not really sure where that's going to go, but it certainly could lead to a sort of late 1990s kind of melt up.
Yeah, I see a strong back half of the year. We're seeing companies digesting, or well, markets digesting the company earnings rather smoothly. I mean, there's certainly a few hiccups, but we haven't seen anything falling off the cliff yet. You could argue the restaurants are, but I expect to see travel and entertainment expenses really take a larger part of the wallet. So I think that that sets up for a nice bounce back area. But overall, for the markets, when we look at the amount of cash that's on the sidelines, and I get the feeling that a lot of the answers for the bearishness on the fund manager survey has more to do with maybe a pullback from an ultra bullish look, perhaps trying to talk down markets a little bit in the hopes that things will fall back to them. That I simply don't think is going to happen. I think you'll see any sort of gyrations like we're seeing right now as we're talking with some Powell comments, a quick bounce back in the markets. I think that's what you could see around any sort of tapering, surprise, or anything along those lines. So my general take is, given the positioning and given the general overall sentiment, I remain pretty bullish on the back half of the year. There might be a little bit of volatility, but again, I'm not looking to really unload any of my portfolio going into the final couple of months here with about 70 days left in the year. So, Brett, there were two other items that I just wanted to talk with you, more news related items. First is the Bundesbank news with German Bundesbank President Jan Weedman stepping down after 10 years on the job. Weedman is arguably the most hawkish member, well, maybe the Australian central bankers, but on the ECB. So his departure is pretty notable, especially since you're seeing a turnover in rule in Germany with the Socialist SPD party coming in. They'll play a major role in choosing the new president. And we know that the German president has a huge influence on the ECB. So, do you see any difference in tone around the ECB with this announcement from Mr. Weedman?
So I would say that you can put this in the context of a larger shift in the culture of who's in charge of monetary policy around the world, with people who have a more hawkish viewpoint, uh, finding easy excuses to hang it up right now. And I think that we've seen that in the United States, and I think that we've seen that other areas in the world, and I think that this is part of that trend. It's sort of, I don't want to do this anymore if you guys are going to be like that. It's kind of, I think, the sort of feel like, why I'm not going to be able to have any impact on it. So why would I keep doing this? And we're going to be making a lot of decisions that I don't agree with. I think that that's what is happening right now among hawks, because I think that they see a lot of shifting, sort of MMT style kind of cultural shifts in terms of how, with the dominant zeitgeist in the world of monetary policy, and being willing to accept 5 to 6% inflation for people who think that the only thing that's important is the stability of the value of a currency and its purchasing power, and there's no other, the single needle compass, like who was it?
Jean-Claude
Yeah,
Trichet.
yeah, Trichet, right? The single needle compass. Like the people who are of that viewpoint, and especially with Germany's history with inflation,
Yeah.
I think that this has become a kind of, the hawks are flying the nest, and it seems to me like that puts in place, the possibility of a longer term sort of structural inflation cycle if you start to fill those roles with people who are, much less concerned
Modern
with that
monetary
outcome.
theory
Yeah,
supporters
I
and
mean, if
stuff of
I
that
don't
nature.
know who's going to fill all of these roles across all of these gradually emptying spots on the hawk side, but if it is a movement toward people then who step into those roles who are far less hawkish, then you could see this becoming a more important, really long term dynamic in terms of economics and markets. But it seems like to me this is part of a sort of larger process.
All right. And then the final news source that we'll talk, Brett, ProShares launched the first ever Bitcoin ETF, BITO. This is attached to Bitcoin futures. And one of the key aspects for this is going to be understanding the dynamics in an ETF on a futures role. We saw this play out in spades with the USO and how that had a massive impact on USO trading. So, Brett, I thought it was important just to kind of take a quick look at this and explain what's going to be going on a monthly basis in this ETF, because people need to understand it if they think that they could just buy this and feel like they're getting invested in Bitcoin, because there is a dynamic on that future contract role that needs to be understood if you're going to be putting money to work in this instrument.
Yeah, right. So I mean, briefly, Um, when you have a futures based ETF, what you have is a trader. You're investing in a trader of that futures market, and that trader has a relatively predictable trading style. What that trader is going to do is he's going to buy this bunch of contracts in a particular contract, that's going to expire at a particular point in time. And as it gets close to that point in time, he's going to sell all those contracts. He's going to buy contracts and the next contract coming up that's going to expire further out in history. And so you're investing in the profitability of that trader. You're not investing in Bitcoin. You're not investing in the Bitcoin futures market. You're investing in how well that trading strategy works out. So you can look at the forward curve of Bitcoin and Bitcoin futures, and you can see that it is in a very steady contango curve, like we talked about earlier with the VIX futures curve, which is in a steady contango curve pretty much forever, except for very rare instances. We don't have a tremendous amount of back data on what Bitcoin futures curve is going to look like. Perhaps it does shift. I don't know what those dynamics are that was shifted, but right now I know that next month is pricing above this month. The month after that is pricing above that month. So M3 is pricing above M2, M4 is pricing above M3, M5 is pricing above M4, M6 is pricing above M5, on out. So what that means is that trader that you're investing in terms of his profitability and his trading style, is going to be taking what are called, roll gain losses. So he's going to be uh, uh, selling low and buying high every time he transitions from one contract to another. And so you're going to lose that bit of price movement. And if you just think about it, what does it mean for somebody to consistently sell low and buy high? as a trading strategy. So there's the ETF is going to perform according to the results of that trading strategy, not in terms of necessarily just what the Bitcoin market does, which means it's going to, as long as this is in contango, it is an absolute guarantee that BITO will sharply underperform Bitcoin.
All right, so there you have it. So, Brett, we're just a little bit over an hour here, so I think that'll do it for us. Unless you got anything you wanted to add at this point.
No, I think we were pretty comprehensive there. I mean, you've
Yeah.
got this interesting divergence between institutional large money managers on the one hand and retail investors and maybe hedge funds, depending on which measure you use, on the other hand. And that's either going to resolve in sort of the typical dumb money, smart money idea that all the retail people piling into the market right now are going to be wrong, and the smart money is going to be right, and it's all going to fall apart, or we are starting on one of those curves like the late 1990s with this divergence, and that we're going to lead into irrational exuberance of some form, which is eventually going to cause, especially when we're at this point in the year and bonuses are on the line, we're going to cause that big jump in cash to start pouring back into stocks as people realize they're underexposed to something that's a melt up. So it's really, I don't know which way that's going to go. I think it's two interesting scenarios, and it forms the basis for analysis.
All right, so there you have it. So, this is the topics that Brett and I will be talking about over the next couple of weeks. Certainly, watching this play out, the dynamics of earnings season going on there, close watch on inflation. So, Brett, as per usual, always a pleasure jumping on and talking about what's going on in the market. I find it to be pretty therapeutic for myself. Hopefully, all the subs do too. And we'll be talking to you soon.
All right, Gavin. It was good.
All right,
My
all
pleasure.
right, have a good one.
Hey, you too.